Good afternoon, everyone. Thank you for joining us for Fiduciary Best Practices for Plan Sponsors. I have just a few announcements. For those of you who are requesting credit, please note that to receive CE credit, you must remain logged into the video portion of the webinar for the entire program. Logging into the audio portion only is not sufficient for CE credit. Continuing education credits are being offered for the following designations: CFP, CIMA, CPWA, CIMC, RMA, and SHRM. Also, at the end of the webinar, we would like to request that all attendees fill out the evaluation form that will pop up. If you have any questions during the presentation, please submit them through the question box. At the end of the webinar, we'll answer as many questions as we can, but we want to be respectful of your schedule and end on time. If we don't get to your question today, we will definitely follow up with you afterwards. Tomorrow, you will receive an email to a link with today's broadcast. Now let's get started. We are joined today by Rich Rouser, Senior Vice President of Thought Leadership at Pentegra. Rich has more than 30 years of experience in the retirement benefits industry and is responsible for helping to shape and define Pentegra's viewpoints on workplace retirement plans, plan design strategy, and retirement success and employee savings trends. Rich, I will now hand things off to you.
Lizzie, thanks for the introduction. Thanks everybody for attending today. We're going to talk about fiduciary responsibilities and all things fiduciary. A couple of things that I put up on the screen that we're going to talk about today are fiduciary failures, which unfortunately can result in personal liability for any individual who seem to be a fiduciary of the plan. We're going to talk also about fiduciary responsibilities of the plan sponsor, because plan sponsors are really ultimately responsible for the sound running of the plan, if you will. And plan sponsors appoint many of the fiduciaries that are acting under the plan. So identifying plan fiduciaries, we'll get into that topic. I think that's one of the more, I don't want to say difficult aspects of this whole thing, but what we're walk through is the fact that many individuals in a company may in fact be acting in a fiduciary capacity, and they may not really know that they're a fiduciary. So I think that's one of the more critically important things to focus on today, and hopefully take away some ideas on that to make sure you don't fall into that type of a trap. We'll talk about some of the strategies and tactics to limit liability, fiduciary liability. And again, number one, I think, is identifying who is actually a fiduciary under the plan. And ultimately, we're going to wrap up with some of the fiduciary correction programs that are available. As Lizzie mentioned, there are a couple of, I think, three questions that we kind of put through here, which are critical for you to take part in order to get continuing education credits. So with that said, we're going to go through the key responsibilities of plan fiduciaries. Again, how to identify those specific fiduciaries who are acting, in particular those who don't know that they're necessarily a fiduciary. We'll go through consequences of those fiduciary failures. And again, some of the other aspects here that are critically important are to think about the DOL fiduciary correction programs. And there's a couple of them that we'll talk about towards the end of the presentation. Hopefully we'll have enough time to get to all this material because there's quite a bit here today. So with that said, we'll kind of launch into it. So this is just, some of the background. We put some statistics here to go over some of the Department of Labor's enforcement actions. And this is some of the stats from last year, 2021. Over close to $2.5 billion of monetary recoveries. That basically means that there were flaws or findings in various plans that the DOL audited or took a look at, and was able to, quote unquote, make recoveries, typically for the benefit of plan participants. There were over 1,000 civil cases that were filed in relation to fiduciary failures, and there were in fact 208, a little over 200 criminal cases. So, this is serious stuff, and it's important to be aware of all aspects of running a plan, qualified plan, and fiduciary actions and or inactions for that matter that can cause problems and could actually cause not just these civil or criminal lawsuits, but could actually result in personal liability to the plan and to the participants if a fiduciary fails to act properly. So, again, critically important stuff here. And you can see the last bullet. That's probably the most troubling aspect if you're a fiduciary, that you could be personally liable for any breach of duties under ERISA. ERISA, of course, is the Employee Retirement Income Security Act that was passed many, many decades ago, and it's been amended and modified by various laws over time. And along with ERISA, there's various IRS notices, and there are also DOL rules and regulations that apply to the plan. And many of those obviously impact the operation of the plan. And therefore, it's critically important for the appropriate fiduciary, right, who's responsible, number one, for the operation of the plan, or for even choosing other fiduciaries that serve under the plan. It's important for those people to truly understand the rules that they're bound by in terms of how they need to act under the terms of the plan and under the law on ERISA. So a couple of things that we'll get into. First is, a couple of the basic rules that kind of highlight fiduciary responsibilities. And the first one that we're going to talk about is the exclusive benefit rule. So fiduciaries always have an obligation of acting in the best interests of participants and or beneficiaries under the plan. I'll get to the second part of that, which is paying reasonable fees in a second. But what this means is that, in many cases, there are corporate folks, corporate staff members, right, who have fiduciary duties for the plan. And even though this rule says you've got to act solely in the benefit of a participant or beneficiary, that doesn't necessarily mean, right, that every claim or every concern raised by a participant needs to be determined in their favor, right? Essentially what that means, though, is the fiduciary has to understand and interpret the terms of the plan in conjunction with rules, regulations, notices, so on and so forth, to operate the plan properly. So the exclusive benefit rule means just that any fiduciary, even though they may be a corporate officer, kind of has to take their corporate hat off and act, as a proper fiduciary under the plan, and act in a manner which interprets the plan properly and applies the rules and regulations properly to all the participants. There's also a prudent expert rule, and essentially that means that all fiduciary actions are held to certain standards of an experienced professional. Now, one of the things that we'll talk about throughout the presentation today is the fact that some fiduciary duties can obviously be done by various corporate officers, but some or all of those duties, many of those duties, I shouldn't say all, because you can't totally outsource all fiduciary duties, but many of them can be outsourced to other organizations, other firms, other individuals. But I do want to draw a line there and say that in certain cases, you may be hiring, for example, a record keeper or a third-party administrator, right, who does testing and compliance and preparation of 5500s. In and of themselves, they are not necessarily a fiduciary of the plan, right? They may be just a service provider. So I'll caution everybody to say that even though you may be outsourcing certain functions, record keeping or TPA services, don't assume, right, that those firms or organizations are fiduciaries with respect to the plan. Ultimately, and put it this way, unless contractually in service agreements they're specifying that they are acting in a fiduciary capacity, you should assume that they're not a fiduciary with respect to their function. Plan document rule, I alluded to this earlier. Fiduciaries have to follow the terms of the plan and basically do that in accordance with ERISA. And when I say ERISA, I not only mean ERISA, but again, all those rules, regulations, notices, so on and so forth that apply to qualified plans. And under the heading of the investment category, there's a diversification rule that the fiduciaries have to offer a broad range of investment alternatives under the plan. in order to meet certain diversification requirements. And that applies, and again, we don't see very many, I'll focus on defined contribution plans for a moment. Put it this way, most defined contribution plans allow participants to choose how they invest their money, and they select from a broad range of diversified investment options under the plan. There are still some plans that exist where the plan trustees will manage that plan on behalf of the participants. We more commonly see that in certain profit-sharing plans, but nonetheless, even though a participant may not have investment options specifically under those types of arrangements, the fiduciaries of the plan still have to properly diversify assets, even if it's being managed on behalf of the participants in the plan. I'll try to flip to another slide here. There we go. Prohibited transactions is another big area of concern for the Department of Labor. And basically, here's a couple of categories that could result in what's called a prohibited transaction: sale, exchange, or lease of property. I'll come back to that in half a second. Lending of money or extension of credit by the plan. Furnishing a goods, service, or facilities is another potential prohibited transaction, or transfer or use of plan assets. So in terms of the top bullet, we sometimes see that issue coming up if a plan, for example, is investing in real estate, and maybe the plan is investing in rental properties. And typical scenario we see is where there could be a prohibited transaction, by the way, is where, let's say, the owner of the business and owner of the business that sponsors the plan buys a rental property, and it happens to be in or near the same town that the company is located in, and they end up leasing the property to the business owner's relative. In theory, it might be okay, but that's the kind of a thing that kind of raises the hair on the back of my neck, right? Because any of this stuff really has to be an arm's length third-party transaction, right? You can't charge rents that are lower than normal rents or subsidized or things of that nature. The other problem we typically see if rental property is in the plan is that it's not geographically diversified, meaning the plan may buy a property in a certain town or county and buy a second and third and fourth. If you're truly looking to avoid any sort of prohibited transaction, geographically diversifying rental properties would be a prudent thing to do. And truthfully, staying away from transactions or leasing arrangements, rental arrangements where there are family members involved or even other employees of the company involved, that, in my mind, can really just lead to problems down the road. I won't get too much into some of the other ones. I think some of the other ones are pretty apparent in terms of what they mean. But again, part of what goes into some of these prohibited transactions is passing the smell test, right? The first part of that should be, is it a reasonable transaction, right, that I'm conducting on behalf of the plan and on behalf of the plan participants? And is it, at arm's length, something that a third party would normally pay that same price for that good or service or rental property for that matter? We alluded to this, or I alluded to this earlier, that fiduciaries can obviously face penalties up to and including civil and criminal fines and penalties. So fiduciaries can be personally liable to make up for losses that the plan may incur, or that the participants may incur. They could be personally liable to return any profits, right, that are part of the breach. Again, I won't go into, we do go into a little bit of fines and penalties here. So the Department of Labor civil penalty is 20% of the amount that was involved in whatever that breach was. Criminal penalties, you can see here, a $5,000 fine and or jail time, believe it or not. And, certain fiduciaries for qualified plans have actually done some jail time for various transgressions here. So, and you can see there's even heftier fines for kickbacks or embezzling money from the plan. And again, that's kind of the crux of those civil and criminal investigations that or lawsuits that I mentioned earlier. So it's, again, critically important to understand the fiduciary role, understand who's acting as the fiduciary, and to make sure those individuals are conducting business, truly in favor or for the benefit of the plan beneficiaries and participants. So we always say it's wise to conduct a fiduciary review of the plan. Number one, top of my list has always been, let's identify who the plan fiduciaries are and what their roles and responsibilities are. So, you can have situations where the head of human resources is deemed to be a fiduciary of the plan, and that might be maybe a more obvious one. But you can have other circumstances where the payroll clerk in human resources is, actually making certain decisions that are really fiduciary type decisions on behalf of the plan and decisions that impact those plan participants. So again, that's what I call somebody like that as the inadvertent fiduciary, right? Somebody who's exercising control or making interpretation of various plan provisions. They may not even know that they're a fiduciary or that they're acting in a fiduciary capacity. So again, critically important to identify who is a fiduciary under your plan or under the plan of your clients, and make sure they understand that they're a fiduciary, make sure they understand the fiduciary role, and make sure that they're really acting properly as a proper fiduciary would. So that's critical, number one. Plan investments. In a lot of cases, we see plan sponsors appointing investment fiduciaries under the plan. We'll get into some of the detail on that in a couple of more minutes. But in a lot of other cases, a plan will determine on their own, the various investment choices, let's say, that are offered in a 401k plan. So again, we'll get into a lot of detail of what that means and how that should work. But again, there should be a thorough process in place to make sure that that's done appropriately. Assessing fiduciary gaps. And again, a lot of that goes into understanding what the fiduciary role and responsibility is, identifying those individuals and or firms that may be serving in a fiduciary capacity, and essentially making sure that you've got all bases covered is the critical important aspect of that. There are strategies you can use to reduce liability at the employer plan sponsor level. And again, some of that involves outsourcing and appointing certain fiduciaries to do take care of certain responsibilities under the plan. The plan document is part of the fiduciary process. In other words, making sure the plan documents, summary plan descriptions, so on and so forth, are up to date and in compliance with law. Most plan sponsors don't do that on their own. They rely on some other service provider. But the real key to that is it's ultimately the adopting employer and or the fiduciaries of that adopting employer or plan sponsor, I should say, that are responsible for the process, even though you might have retained a record keeper to provide the document, or a third-party administrator who's preparing a somewhat standardized or non-standardized plan document, making sure that they're up to date with current law, they've been amended timely with respect to law changes and all of that. So it's critically important to make sure that is part of the process. And it's important to reassess, the plan on an ongoing basis, to do essentially a fiduciary review of the plan to make sure that you've got all the bases covered. So let's talk next about identifying plan fiduciary associated with a qualified plan. So typically in the plan document, there's something called a named fiduciary. It could be the company that's sponsoring the plan, but ultimately that responsibility as a fiduciary lies with, if it's a generic naming of the fiduciary, it's really ultimately typically the business owners and or it could be the board of directors that is part of that fiduciary role, if you will. So again, understanding who's a fiduciary is important. And again, a fiduciary is anybody who's got discretionary authority over the management of the plan or the assets. And again, that's what I said earlier. the head of HR may be deemed to be a fiduciary, and that may be a parent, it may not be a parent, right? Many companies set up a retirement plan committee, right, that reviews the operation, and you could have very specific committee members. Undoubtedly, they're all going to be fiduciaries under the terms of the law. So again, critically important. They understand that just because they're on the committee helping make decisions, they could ultimately be literally personally responsible for any failures or breaches of fiduciary duties. The third bullet here is anybody who offers investment advice with respect to plan assets for a fee. And again, that one is probably pretty well known, in particular for plans that appoint investment advisors to help with that process and to step into a fiduciary role in terms of selecting, monitoring, managing plan assets, that sort of thing. So, breaking down the various categories, ERISA 338 is really an investment fiduciary under the plan who's responsible for those aspects of the plan. 321 is, I want to say, a similar but not identical role, because the 321 is really, basically digging into searching investment opportunities and making recommendations, but they don't ultimately make a decision. And ERISA 316 is the administrative fiduciary of the plan. And that's one of the ones that I kind of alluded to earlier. If you're hiring a record keeper, a third-party administrator, to fulfill some of the functions, the operational functions of the plan, there's, again, in most cases, I should say, unless they specifically say they're signing on as a fiduciary, they are not a fiduciary just because they're covering the operational basis of the plan. So ultimately, there is some other responsible person typically at the company, whether it's the retirement committee or the business owners or the board of directors of that company, that are responsible for that, making sure that those functions are happening properly, that the terms of the plan are being carried out properly, and an interpretation of the plan document. A lot of times we see situations where record keepers or third-party administrators might have applied, I'll give you a few examples, might have applied the wrong vesting schedule. Ultimately, you could point to them and say, well, you did this wrong. But ultimately, are they responsible for making up losses to the plan or things of that nature? If there's a breach, not necessarily, right? It's really the fiduciary who's responsible. You would have to look at the service agreement for that practitioner to see how much financial responsibility they would really have. In a lot of cases, we will see service agreements that say, well, we're responsible for rebating fees, but not anything more than rebating fees for some period of time. That wouldn't necessarily cover all the flaws that might have occurred due to coding the plan improperly from a record-keeping standpoint. So, again, critically important to understand who is truly a fiduciary under the plan. So another aspect of fiduciary is something called the co-fiduciary, where one fiduciary can be liable for a breach of another fiduciary. And again, a lot of this, I want to say, goes to common sense, but again, it's really worth highlighting, because if you're a fiduciary and if you know that there's a breach by another fiduciary, you have a responsibility to do something about it. You can't just sit idly by and kind of ignore the situation when, in fact, that there's been a breach or is about to be a breach committed by another fiduciary. You have to step in, you have to say something, and you have to do something about it. So you could end up, also being responsible if you have knowledge of certain things that need to be corrected, that have to be corrected in accordance with law, with ERISA, the IRS rules and regulations, Department of Labor rules and regulations. You have to step in and actually do something. So you can see in the bolded part at the bottom of this, plan sponsor should closely review service agreements with co-fiduciaries. That's to make sure that everybody is aware of the duties of other fiduciaries. So if they, to quote a phrase, if you see something, say something. That's really the message that all fiduciaries have to abide by. They can't just sit idly by and let things happen. Lizzie, that brings us to our first of, I think, 3 questions today, and it's a true or false question. Hopefully the polling piece of this is up. So the question is, the plan sponsor can outsource some but not all of its ERISA 316 fiduciary responsibilities, true or false? Now again, just to remind you, ERISA 316 covers the operational aspects of the plan, whether it's record keeping, whether it's the third-party administrator function of doing benefit calculations for individuals or applying vesting standards. It also involves enrollment of employees timely into the plan. So the question is, can you outsource some but not all of the duty? Is that true or false? Lizzie, I don't know if you are ready to close the poll.
Yep, the poll is now launched for answering, and I will leave it up for about 10 more seconds. For anyone who hasn't selected an answer, please do so.
Okay. And when you get some results, let's find out what the results are.
Okay, the poll is now closed. I am now sharing the results. And Rich, it looks like 85% said true and 15% said false. And the correct answer is A, true.
And sure, so let me go over why you can outsource some but not all of the responsibilities. The way we think of this is that, most fiduciary responsibilities can be outsourced. I can outsource record keeping, I can outsource third-party administrative services, right? Testing, compliance, 5500 preparation. I can outsource the investment side of it. I can outsource the 316 role, which covers, right? That 316 is covering the operational aspects of the plan, could be potentially including selection of the auditor if it's a large plan. But ultimately, the plan sponsor and/or fiduciary at the plan sponsor is responsible, right? Number one, for selecting and appointing the 316 fiduciary. Number two, they're responsible for monitoring that fiduciary. And number three, still responsible for assessing whether or not there are reasonable fees involved. So I want to put that in context, right? That doesn't mean that you need to be an expert in all of the things that you've delegated to that 316 fiduciary. It does mean that you need to take steps to make sure that they're doing their job. It's just like the other day, we had some roof problems here, and I had to hire a contractor who obviously is an expert in doing the roofing job. I'm certainly not an expert, and I certainly didn't get up on the roof, but my job in hiring that contractor was to make sure, are they qualified? Are they insured? I got some competitive bids on the job, right? And I checked to the best of my ability to make sure they did what they said they were going to do. So it's put that into the context of a qualified plan. You don't have to be an expert in every facet of everything you've outsourced to the ERISA 316, but you do need to make sure that their service agreement is what you think it is. And I'll give you a couple of crystal clear examples on outsourcing 316 services, because a lot of companies have kind of jumped into that side of the business. What I find more often than not is that the service agreement for that ERISA 316 doesn't cover everything that you would think they would cover, right? And in particular, they will specify certain items where they're clearly not a fiduciary. I'll give you a few examples of those. That fiduciary 316 is not going to be responsible for making contributions to the plan, right? Timely, right? That's on the plan sponsor, the employer that sponsors that plan. Contributions have to be made timely. They're also not necessarily going to do a search to assess whether or not the fees that you're paying them are reasonable fees, right? That lies with the plan sponsor. So we always say, and the third component is data, right? The plan sponsor is ultimately responsible for getting data to the record keeper and or the third-party administrator so they can actually do their job. So there's always a couple of exceptions to total outsourcing. You can't completely outsource it, but the closest you can come is to make sure you as a plan sponsor have hired a 316 fiduciary, and that the only really couple of things you got to do is give them the data fund the plan properly and timely, and assess that they're doing their job or doing the job that they said they're going to do. And the fourth thing I'll throw there is, to the extent that they're not doing everything that a 316 is responsible for, you would have to fill the gap. We mentioned that in one of the earlier slides, identifying gaps in any of the services being provided. So that's a good segue into strategies and tactics to limit fiduciary responsibility. And so I'm going to talk next about the investment policy statement, the IPS, as I refer to it. An investment policy statement is not required by ERISA. But I can tell you this, having an investment policy statement, I think, is really, really good practice, best practice, if you will. And it really kind of lays out a level of protection for the plan sponsor to basically protect themselves and defend themselves in a situation where participants may claim that investments were not properly diversified, or the investments were not reasonably priced, or that there might, and we've seen a number of them, more than a few of those lawsuits in our industry, right, where participants will sue plan sponsors for everything from the funds that you chose to offer the participants didn't do as well as other funds that were available in the marketplace, or that even funds that in a down market are losing money, right, so to speak. Maybe they lost more than some of the peers. So an investment policy statement is going to go through, and I've seen very simple ones, and I've seen much more detailed ones. But they're going to go through a method of selecting, I'll call it screening investments, selecting investments, and ultimately monitoring the investments that are in the plan. And one thing I'll say with respect to fees for services, whether it's fees that the investment fund charges or just services in general, the Department of Labor has said that the cheapest, lowest cost is not always necessarily the absolute best choice. You always have to look at what's happening specifically with those services. Now, here I'm talking specifically about investments. So, certain claims that we've seen out there that, gee, the fund didn't perform as well as other funds. Well, that broad statement is not necessarily the full fact, right? There's also the risk factor of the fund, right? Is it a more risky fund or a less risky fund in its asset class or asset category? So there's a whole host of things that need to be considered, right, when you're developing an investment policy statement. Now, if a plan sponsor has outsourced that function to an investment advisor, typically we'll see that investment advisor help put that investment policy statement together. They'll typically do that in conjunction with discussions with the client, with the fiduciaries at the plan level, to identify, the parameters that go into that investment policy statement. And, one of the things to consider with investments in general is, are the investments that are offered reasonable given the population of the plan? And most plans, we see a variety of individuals that are participants or beneficiaries, right? There are some very sophisticated individuals, and there are a lot of participants who are not that sophisticated from an investment standpoint. So, arguably, you could see certain plans with a lot of very knowledgeable participants offering an array of investments that could differ significantly from what I'll call the typical defined contribution plan in the marketplace, which are generally designed to offer more broad categories of assets. Now, the one thing that I'll say about investment policy statements, they're great, and I think certainly a best practice to have for each and every plan. But once you have one, it's critically important to make sure you're following the terms of the investment policy statement, right? Because, that same document that is protecting the investment fiduciary and ultimately the plan sponsor, if it's being operated in a way that doesn't comply with what you said it was supposed to do, right? The process, procedure, controls, and all that, You can actually, I don't want to say hang yourself with it, but essentially it's important to make sure the IPS coordinates with the philosophy of the plan, and to make sure that anybody who's having any discretionary control over the plan investments is following the guidelines of that investment policy statement. And by the way, if there are certain aspects of that IPS that are not appropriate anymore, well, guess what? It can be changed, right? So it's important to follow what you put in writing. And again, that's kind of the theme of what I'm going to be obviously talking about today. Documentation of what's happening at the fiduciary level is critically important. The various lawsuits that are out there on fiduciary breaches, in many, many, many cases, to the extent that there was documentation that certain decisions were made, that decision doesn't always have to be the correct decision. Hindsight, 2020 is wonderful, but fiduciaries can make decisions that turn out not to be, there could have been a better alternative had they done something differently, right? But the fact that there was documentation of a committee meeting, of an investment review meeting, right? Minutes to that meeting is critically important to, reduce liability down the road. So documentation is key. So we'll keep that in mind as we kind of move through things here. So again, just for the benefit of putting the detail here, that investment policy statement goes over the objectives and the purpose of that investment statement, right? Goes over the roles and responsibilities of who's involved in making those investment decisions. And again, I mentioned earlier the difference between an ERISA 338 investment fiduciary versus a 321. A 338 is going to be responsible for pretty much all of this stuff, whereas a 321 will review and help recommend funds to be used under the plan, but a 321 doesn't make the ultimate decision. It's kind of a shared responsibility, typically between the plan sponsor, whoever's appointed as a fiduciary there, whether it's the retirement committee or certain officers of the company, and that ERISA 321. So again, understanding what type of investment fiduciary you've retained, if you've retained an appointed one, is critical. Understanding your role in that process is also critically important. And again, anything that gets put into the investment policy statement on a going forward basis certainly could be changed if it's no longer meeting the needs of the plan or the participants or that plan sponsor. Fee disclosures are another aspect of laws, and I hate to give the gobbledygook, right? But 408B2 notices, 404A5, and ultimately 5500 report, return report is another aspect of this. But under the 408B2 rules, right? This is fee disclosures with respect to service providers, the fee disclosures that are given to plan sponsors of qualified plans, whether it's defined benefit or defined contribution plan. And the general guideline is they've got to disclose any direct or indirect compensation of $1,000 or more. That's one level of fee disclosure notice that is given to plan sponsors. The next level is the 404A5. That's where the plan sponsor provides information to the participants in the plan. And critically important for obviously defined contribution plans, where those participants are directing their own investments under the terms of the plan. So those disclosures have to contain plan provisions, investment-related provisions, and it has to be provided annually and as part of the quarterly statement. So that's kind of another aspect of fee disclosure. I know we didn't, purpose of today isn't to talk about upcoming potential law changes, but Secure 2.0 and some of the other proposed legislation that's out there is looking to help streamline some of the, in particular, participant disclosure notices, because there's a whole bunch of different notices that participants have to get these days. So, it tends to be burdensome, but here's the point. If, as a fiduciary of the plan, you're not complying with providing the appropriate notices at the appropriate point in time, that can be deemed to be a fiduciary breach. So that's kind of a problem. And obviously, A lot of this information gets reported on the Form 5500 that's filed on behalf of the plan each year. And again, there are sections, certainly in the large plan filing, where direct and indirect compensation of $5,000 or more is specifically identified and reported. So, and DOL and IRS, they use certain audit purposes too on some of the qualified plans. And particularly, you'll see that on some of the larger plans. So that's part of the process here. I mentioned fees. Overall fees that plan sponsors or participants are paying have to be reasonable. Fiduciaries have a responsibility under the law, under ERISA, to make sure that they're reasonable for the services being provided. And I mentioned earlier, Department of Labor has certain guidelines out on this. And you know what they've said is you don't always have to choose the lowest cost service provider, because that lowest cost service provider may not be providing service that are as robust as service providers that charge more. But you do need to be aware that and cognizant of the fact that you're not, quote unquote, overpaying for services. And you know, it's almost like applying, you know, your daily living, right, to the plan. You know, my roofing example, it's, well, yeah, I got, you know, 3 quotes on, you know, fixing a portion of the roof, right? And, you know, during that process, it's a little bit of an education for me, right? Understanding something I didn't really understand before, making an assessment, making a judgment, and selecting ultimately the right person or the right company to do the work. Same thing with the plan. And I think some of the issues we may see with qualified plans are the fact that, you know, there are typically numerous fiduciaries involved, and you got to be a little bit careful of the "it's not my job" kind of scenario, right? It's you know, I'm head of HR and I have certain functions. I got to provide certain data. I'm not responsible, may not be responsible for the investments. But I mentioned earlier, if that fiduciary is aware of certain other things that are not happening properly, it's their duty to kind of step up and say something about it and do something about it. So again, lawsuits that we see out there are picking on fees quite often. Having the cheapest service provider may not, in fact, be the best solution. So I want you to be careful in terms of not just necessarily choosing the cheapest, but choosing the best service providers at the most appropriate fee for the services that they're providing, I think is one of the keys to success there. So some of the things here, and again, I touched on some of this with my roofing example, right? You know, take a look, number one, at their disclosures. What are they disclosing? Ask for a sample before you hire them. Ask them to explain various fees and the services they provide. Scrutinize their contracts. Make sure, and I use that example when I said, hey, if you're going to appoint an ERISA 316, are they really doing what you expect them to do for the fee that you're paying them? And again, sometimes there's a lot of blank spaces. There are a lot of exceptions for, I looked at a service agreement not too long ago that had 2 pages of here's what we're going to do and 5 pages of here are the things we're not doing. So that's a good example of understanding what you're getting and understanding what your fees are covering, and making, I think most critical is making sure you have uncovered bases covered is part of the message there. So you can go about fee surveys a couple of different ways. You know, there's tons of info on the web, right? But you can also request competitive bids. There are proprietary, you know, tools online and free tools that you can do some assessments for this. But again, critically important to understand, and this is probably the hardest part of this job, is understanding, is that service provider that's a record keeper or a TPA, are they a fiduciary? If they are, you know, in my view, you're paying for something that is worth more than a service provider who's not acting in a fiduciary capacity. Again, that's why I say looking at the cheapest fee is not always the best part of the equation to make that determination. So that's important. This I mentioned earlier, you know, large plan filers have certain additional disclosure requirements on the 5500. And again, those are specifically identified. You'll see names and amounts that people were paid. You could see a law firm who drafted a plan document, or a law firm that got paid to, help you as a fiduciary resolve a certain issue that a participant may have raised. If that compensation to them was $5,000 or more, that's, and if it was paid from plan assets, that's going to be required to be disclosed on the 5500 filing. So that more or less applies to large plans, but again, it's good practice for any size plan to understand who you're paying, what you're paying, and what you're getting for the fees that you pay. Gifts and entertainment. We've got a bunch of bullets here on that. I think the number one takeaway here is, I would just, if you're responsible as a fiduciary, I would stay away from any of this stuff. To me, it's not worth getting involved in any of these sorts of transactions that are either reportable events or could be scrutinized down the road as being deemed to be inappropriate. So, don't. And I know most people on this webinar are not thinking like this, but the plan is not the piggy bank. So, if you're helping your client, for example, caution them please to stay away from gifts and entertainment and any of that kind of stuff that might be paid with plan assets. It's critically important. So and again, we talked a little bit about annual participant disclosure notices, and there's certain plan information disclosures that have to be made. And, there's general info, admin expenses, and individual account expenses. But, just going a little bit deeper on that, on the general aspect of the disclosure, you have to disclose to participants when and how they may be able to give investment instructions. You have to give them an explanation of any, plan limitations on the investment instructions, right? So, and what I mean by that is, we've seen plans that have maybe a stable value account and maybe also have a money market account. It's not that common, but we've seen it. And in many cases, most cases for that matter, if you've got a stable value investment in the plan, I shouldn't say prohibited, I don't want to mix words, a transaction that's not allowed is for a participant to move money directly from stable value to a money fund. That is, in every stable value agreement I've seen, a transaction that cannot and should not occur. So again, you have to kind of look to the record keeper who's doing that work and make sure they don't allow that type of transaction. But more specifically, what we're talking about here is giving notice to participants that they can't make a transaction. But again, I'm going to go back to the other part of the fiduciary job is got to make sure your record keeper, who probably isn't a fiduciary, isn't permitting that kind of transaction. Because quite honestly, in today's environment, not unusual to see a stable value fund paying 2.5%. And what I've seen, money fund rates are in excess of 3% these days. So, a participant in a plan like that who's got money in a stable value account might reasonably say, hey, I want to move money to the money fund. I'm getting a higher return in today's environment. Can't do that transaction. So that's, again, really, I'll get back to what we're talking about now, which is disclosure. But as important and probably, just as important is the fact that you don't let your record keeper make that kind of a transaction directly. Information on voting rights, for example, that may pass through to participants has to be disclosed in this kind of a disclosure. Other expenses that can impact a participant in the plan, expenses to do a qualified domestic relations order, things of that nature has to be disclosed. Obviously, we talked before about investments, but investment-related expenses have to be disclosed. Actually, that's on the right-hand side of my slide here. But also benchmarking is, goes into all, I should say, participant-directed plans these days. And, benchmarks have to be appropriate and have to, enable a participant to make reasonable decisions based upon, actual performance of the fund versus benchmarks that are applicable to that asset class of fund. So again, disclosures these days are extensive. and detailed. And unfortunately, it's kind of sad to say most participants are kind of overwhelmed with the amount of material that they get, and it's hard for them to decipher what's what. But all I'm saying is, as fiduciary of the plan, you've got to make sure that the disclosures are happening, that they're getting out to the participants timely, and that if they have any questions, certainly that they're explained to the participant. But they have to be full and robust and contain all the necessary data. In terms of quarterly statements, a couple of things here from the administrative side. There's got to be a reporting of the dollar amount of fees, a description of the services, and a general statement on any revenue sharing. We see less and less revenue sharing these days. It still exists. But, I would say, and by the way, revenue sharing means that the investment fund is paying some revenue, maybe to a record keeper or maybe to a third-party administrator to do certain tasks that, if that were an individual account under that investment fund, that investment fund would provide directly to the participants. So, my general line of thinking is just my opinion is if I had a choice between a rev share fund and one that doesn't share revenue, I would go with the non-rev share. There's less likelihood of scrutiny on that kind of an arrangement. And on the individual side of the equation, disclosure of the dollar amount of fees as well as description of services is critical on those quarterly statements. So here's another tip, right? Best practice is to do a periodic plan C audit to make sure that there's adequate information provided to the participants to enable them to evaluate the fees, for those funds or services for that matter. Again, making sure those service providers are providing the documentation that you may be required to give to the participants. What else do we have here? And do the participants understand the disclosures? That part of it can typically be done, obviously, in written format. That's probably the basic requirement here. But a lot of times that can happen if you're doing any sort of group meetings or group educational aspects with participants. A lot of firms will do this part of it via, whether it's a webinar or a video conference or things of that nature, or even pre-recorded clips that talk about that type of stuff to help participants truly understand. Another aspect of investing in plan and kind of protecting plan fiduciaries is to comply with ERISA 404C, which reduces employer liability, which essentially shifts responsibility for the investments to participants and beneficiaries. Most 401k plans are participant directed these days. So a couple of basic requirements: those participants have to get adequate information to make intelligent choices. The fee disclosures actually replace a lot of the information that was required under the original 404C provisions. Participants have to be able to make periodic changes to investments. Again, most 401k plans we see daily valuations. So any day the markets are open, typically participants can trade in or out of certain funds. And again, I mentioned that one restriction that applies to all stable value funds. And again, the diversification board at the bottom, that there's a broad range of investments for those participants to select. So if you comply with all four of those bullets, essentially you can relieve fiduciaries of the plan of certain responsibilities on the investment side of the equation. And again, we've got information here on conducting a 404C compliance audit. So I'm not going to go through all of these bullet points, but I think it's a pretty good checklist to go through periodically if you intend to comply with 404C. We see a lot of plans, most plans for that matter, trying to comply with 404C. 404C is a great protection. On the other hand, it's a great mechanism to get fiduciaries in trouble if they don't comply with all aspects of 404C. You're only afforded the protection if you comply with all those disclosure requirements that I mentioned earlier. So it might be wise to do that kind of an audit periodically. We do see plans that choose not to comply with 404C. They tend to comply with the prudent standard rule, which basically says, what would a reasonable person do in a typical situation? And sometimes plans use that approach as opposed to the 404C, aspect of it. QDIAs, qualified default investment alternatives. We see this in most 401k plans these days where, if a participant fails to make a choice on how to invest their money, it goes into a QDIA. And typically, I think we've got a slide coming up that goes over a couple of those things in a minute, but target date funds and certain managed accounts would meet those requirements. So that's out there, and then most plans use that type of QDIA. So under the heading of QDIAs, there are specialized funds. So there's multi-age target date or life expectancy based target dates out there. There are single funds. So, for example, a balanced fund might be used as the qualified default investment alternative. We don't see that too often. We still see it sometimes, but critically important to, if you're using a single fund as that QDIA, it's critically important to assess the typical participant in that plan, right? If that typical participant is, 58 to 65 years old, the older end of the scale, a balanced fund might not be the appropriate choice. A more conservative, fully diversified fund might be the better choice. So again, single fund is a possibility, but there's definitely some more monitoring that would have to occur with that. There are managed accounts that can work into the equation. But again, typically what we're seeing most are target date funds that are utilized in this side of the equation. So again, we suggest you do an audit. Maybe it's more of a checklist item. We're using what type of default investment are you using, target dates or otherwise. We could spend a whole nother presentation on the various types of target date funds and the glide paths and risk tolerance levels, so on and so forth. That's kind of a whole separate topic. But identifying, are you using this type of feature? If you are, is it the appropriate feature, and is it working properly given the demographics of your plan? So with that said, Lizzie, we have our next question for today, which is, which of the following would be considered a QDIA, qualified QDIA, right? So a target date, a managed account, a money market, all the above, or last choice is A and B. So we'll pause a couple of seconds to gather some results. And I know we're running a little tight on time, so we won't keep this one open too terribly long.
No, Rich, I'll go ahead and close the poll. We're almost done with the audience voting. So let me close the poll and share the results.
Good.
All right, so the majority of the people answered A and B, which is the correct answer. Target date fund and managed account were A and B.
All right, good. Appreciate that. Thank you. That's obviously the right. Qualified automatic contribution arrangements. There are certain requirements. They have changed over time. But essentially, it provides for automatic deferrals when a participant is automatically enrolled in the plan. Typically starts at 3%, can go as high as 15% of pay. There can be I call it auto escalation, 1 or 2 percentage points per year. That brings that rate up over time. Personally, I think the law should have been written that starts at 6%, but it is what it is. And there's a couple of different ways to do the employer portion of the contribution, right? You can see it here in the fourth bullet on the slide. I won't go through all the details, but you also have to offer either a full vesting or a full vesting after no more than 2 years. But again, in order to use a QACA, as I call it, Qualified Automatic Contribution Arrangement, you have to disclose it, and you have to enable participants to opt out of it. So right now it's optional. There may be some changes in law coming down that are going to push that harder. But, typically what Aquaca does is it kind of provides participants with a negative election, essentially saying, hey, we're going to sign you up for the plan unless you choose not to defer money into the plan, or unless you choose a different starting deferral rate to begin with. So we had a quick example.
Sorry to interrupt. We're right at the top of the hour. Can you skip ahead to the final polling question?
To go to the final polling question,
there we go.
which is, who hires a fiduciary advisor for a plan? The Department of Labor is A, B is the Internal Revenue Service, C is the plan sponsor, or D is the SEC. So when we have some results, I wouldn't keep this open too terribly long. And
no, it looks like 100% of the audience has selected plan sponsor, which of course is correct.
Excellent. So we've done a good job, certainly on that portion of it. So one final comment, by the way, if there are any questions, we'll follow up after this webinar over the next couple of days. But the last section, which I'm not going to go into a lot of detail, there are various IRS and Department of Labor correction programs available. So here's the takeaway from the next couple of slides, which again, I'm not going to go into. They'll be in the deck that you get tomorrow. If you have a failure of any sort, the first question would be, how do we go about correcting it? And there's a lot of ways of self-reporting issues and errors, whether it's an operational failure, an investment failure, whatever it may be. Various ways of doing that. It's always prudent to do that on your own through a voluntary program, because the last thing you want is the IRS and the Department of Labor auditing the plan 3 years from now and looking back to 2022 or 2021 and saying, hey, we found an operational failure. So best for you to, A, recognize it, B, work on correcting it, and C, self-report under the various programs, which quite honestly makes it relatively inexpensive to do the fix, certainly in terms of fines and penalties. So with that said, I appreciate everybody attending today. And if you have questions, please send them in and we will follow up. Thank you again.
Thank you, everyone. Just a reminder to please answer the questions that will pop up right after we end the webinar. Have a good rest of the day.